So we are into the topic number 2 in this chapter, that is fiscal policy. So yesterday I have discussed and explained you about the fiscal policy. This is related to taxation. Okay. So
Yeah,
fiscal policy seeks to influence the economy by managing the amounts which the government spends. So what government wants to spend on its on citizens, what facilities they want to develop in a country, and it depends how much requirement they have. Okay, so based upon requirement you want money, so that money you will collect from the people in form of taxes. It is not only taxes, the government can bring the money from World Bank even for their development activities. Okay, but that is like taking a loan. Excuse me. Okay. So based upon the requirement, they want money. Okay, so they can either increase the taxes or they can bring the money from World Bank. They can even borrow. But this is upon the government's policies, whether they want to borrow, whether they want to collect in form of taxes, whether they want to balance the act, like some borrowing and some taxes. So usually we see during the time of election, what government does is they very smartly say people that we are going to reduce the taxes. So how are they going to fulfill this gap? By borrowing. And when the election is done, they again come to their original roots. If they win, again they are going to continue. They are going to increase the taxes, okay, and stop that benefit. So these kind of tricks the governments usually play. So let's go ahead. So fiscal policy can be used as an instrument of demand management, of course, based upon demand. If your demand is high, you would impose more taxes. Demand is less, you would impose less taxes. Correct? Because the taxes are the only way which can give revenue to the government. Now, a government might intervene in the economy by spending more money and financing this expenditure by borrowing. They can do this, as I said. Either they can do one more thing, they can, for spending more money, whatever the finance they require, they can either collect more taxes, okay, without collecting more either they can collect more taxes and they don't want to spend more on public even, that can also happen. Either they can collect more taxes and spend more on public for developing more and more the economy, okay, thus diverting income from one part of the economy to another. That means they are taking from you and they are passing on to you the benefits. So either they can borrow and spend, they can collect more and spend more, they can collect more and spend less. That can also be the case. Okay. Excuse me, I just got a call. Now, so government spending is an injection into the economy. They are injecting money into the economy. Okay. Adding to total demands for goods and services in the economy. So now known as aggregate or total demand and therefore national income. So government spending is an injection into the economy that adds to the demand. That means definitely people want more and more facilities, more and more services, more and more spending is required. Henceforth, government will do that, and that will increase the national income. Because if people want set facilities, government will charge for it. Whereas taxes are a withdrawal from the economy. Government spending is okay. Government is spending into the economy, But again, taking money from people in form of taxes is withdrawal. So fiscal policy can thus be used as an instrument of demand management, that is deliberate policies to stimulate and control the level of aggregate demand in an economy. That means when high demand, they'll charge more taxes, less demand, they'll charge less taxes, anything. So too little demand creates unemployment, too much creates inflation. These are the two problems. If there is very less demand in the economy, that means there is no jobs for the people. Why? Because there is no demand. So the production sector has no work. So when the production sector has no work, so how will the people get jobs? It is very tough. And secondly, when there is no job, what people have, and in fact when people show a lot of demand for things, so that also leads to high inflation. Am I right? Demand pull inflation, correct? So fiscal policy appears to offer a method of managing aggregate demand in the economy. How they manage the demand? This demand, which is creating two issues: very less, high unemployment; very high, high inflation. So how they would control this? So if government spends more, for example, on public works such as hospital, road, and sewers, without raising money in taxation, that is borrowing more, it will increase expenditure in the economy and so raise demand. That's what happens. See, government is not collecting money from people, so government is getting less money from the people, which was an easier source. So that money government is bringing from outside countries, okay, and that means from World Bank and other supra like national organizations. With this, what is happening? The burden is passed on to people. That means you need to pay higher amount for the services. If suppose Indian Railways is given a task of making some 300-kilometer track and one particular line and operate, the charges would be very less. But if the Japan's or some other Siemens or other German or Japanese or French companies have been given a contract that you make this line and you operate this, charges would be very high. Charges are high only when the demand would be high, or the charges are high because of the that shows a higher, that depicts a higher demand. Okay, now, so if government kept its own spending at the same level but reduced the levels of taxation, it would also stimulate demand in the economy, because firms and households would have more of their own money after tax for consumption or saving, investing. That means you people, if government is charging less, that means taking less taxes and spending from their own resources, so people will save more. Okay, when they save more, they want to spend more and they show unnecessary demand for goods. Okay, so so government is doing its own spending either from its resources or anyways or borrowing, because there are many government companies also. So that will also create demand, and in some way a government can reduce demand in the economy by raising taxes or reducing its expenditure. This is a contradictory policy. That means not levying taxes is expansionary, levying high taxes, reducing demand is contradictory policy. Okay, fiscal policy and businesses. See, fiscal policy affects business enterprise in both service and manufacturing industries in various ways by influencing the level of aggregate demand. That means if the demand is high for goods and services in economy, macroeconomic policy affects the environment for business. Business planning should take account of the likely effect of changes in aggregate demand for sales growth. Yeah, we have to, being a business, if we have a business, we should see whether there's a demand for the product or not. If the demand is high, the sales growth will be high. For example, a drop in aggregate demand might mean lower demand from customers for a business product and services. So business planning will be easier if government policy is relatively stable. Yes. So many of the businesses they depend on government policies. If GST is high in some sector, what happened in real estate sector, in many of the builders, some 4 years back, 3 or 4 years back, if you see the story, 12% GST was levied on apartments or flats. Okay, so when 12% GDP was levied on apartments or flats, so people were buying less, because this kind of reduce the demand, because the taxes are very high. Now what government should do? They should reduce taxes to increase demand in the real estate sector. So they made it 5%. Now the GST on apartments or newly constructed building is 5%. Now the demand has ultimately increased. Now, tax changes brought about by fiscal policy affect businesses. For example, labor cost will be affected by changes in employment taxes. That's what. Now, if you are working in a company and you are a salaried employee, so if the government is charging more, they have increased more taxes, that is not good. The spending would reduce. Am I right? For example, if indirect taxes such as GST and other taxes, like such as sales tax or excise duty rise, either the additional cost will have to be absorbed or the rise will have to be passed on to consumers in form of higher prices. So if the employment taxes are high, these taxes can be reduced. Direct taxes is high, indirect taxes can be reduced. If direct tax is less, indirect taxes will be high. However, in whatever ways the government is trying to eat away, however they want, they can eat money from you. Okay, they can withdraw money from you in form of taxes. Now, monetary policy, I already told you, to control the inflation, the governments make the monetary policy. So monetary policy are very important. Okay, so what comes under monetary policy to control inflation? What government is going to do? Aims to influence monetary variables. What are monetary variables? What which are not stable? Okay, such as the interest rate. So interest rate, it is not stable, it is a variable thing. LIBOR plus. What is this LIBOR plus? LIBOR is nothing but London Interbank Offered Rate. That means if there are two banks, Bank A and Bank B, if this bank wants to borrow from this bank, so the rate what this banks charge on this bank is LIBOR. Okay, that is bank to bank rate. Okay, overnight LIBOR, 3 months LIBOR, 6 months LIBOR. You're going to learn them. So monetary policy aims to influence monetary variables such as this interest rate and the money supply in order to achieve targets set, such as targets for the rate of inflation. So the monetary policies are of course prepared by the governments to control this particular evil thing, or devil I say, the inflation. Okay, now for that they would try to come out with certain policies. We are going to see now. So money is very important, of course. To run an economy, you want money, and total money in the national economy may have a significant influence on economic activity and inflation, of course. So if you have less money, if suppose you take it individually, you have 1 lakh, so you will spend less. You have 20 lakhs, you will spend more, correct? So if the money is more, economic activities will be high. If the money is less, economic activities will be less. If money is more, people will buy more and inflation increases. If money is less, people will buy less, inflation decreases. More demand, more inflation. Okay, now the role and aims of monetary policy. So why are these policies framed? Monetary policy is a regulation of the economy through control of the monetary system. So whatever the like lending and borrowing happens, that comes under the monetary system, and to have a control on that, these policies are made by operating on such variables as the money supply, the level of interest rates, and the conditions for availability of credit. So what they do, they try to fix certain things. They try to make policies so that they can control the money supply to reduce the inflation. They can try to increase or decrease the interest rates to reduce the lending. Okay, if the interest rates is high, if the interest rates are very high, the loans are very costly, people will borrow less. Okay, and people will deposit more, and the more money if you have, the more stronger you are. Got my point? So all these things they will do. Let us see. The effectiveness of monetary policy will depend on whether the targets of monetary policy are achieved successfully. So why you make a policy? To achieve your targets. Whether the success of monetary policy leads to successful achievement of the intermediate target, that is to decrease inflation, what happens? The banks will increase interest. Okay, with this, more and more people will deposit their money. They spend less in the market. Why? Because things are already very costly in an inflated economy. So they pay more and they get less quantity. So their account is kind of the account balance is getting reduced by a higher amount. So to control this, for the time being, see, inflation is not a permanent phenomena. After some point of time, the demand would decrease. Okay, for certain things for which you show a lot of demand, correct? So So till that point of time, you can try to hold your money, and government will also encourage you for that to control this inflation. They'll increase the interest rate, so that will make you to deposit more money or invest more money in the market in certain instruments whereby you can get higher interest, and these banks will attract more deposits, and the lending would be less opted. That means the borrowing side would not like to borrow from the banks because the interest rates are high. So for them, the loans are costlier, and if they take costly loans and produce, their finance cost is high, so their products cost would also be very high. Since the product cost would be very high, people already are facing a lot of issues in this inflationary economy. They would not purchase the costlier goods. So these companies would like say why to produce more and why to take a higher loan and why to expand in such kind of economy right now. Let the situation ease and then we will do that. So money is then not going outside from the bank, and the banks are becoming more and more stronger, more and more stronger. So the sector is becoming strong. So what happens? You feel stronger if you have 20 lakhs or 1 lakh. Always when you have 20 lakhs, you feel more stronger. So in this way, they are trying to control the inflation. Okay. So if the money supply is very much high, that shows that the purchasing power of the currency is very less. Okay. So money supply should be controlled, and money and that would control the inflation. Okay. Now, so whether the successful achievement of intermediate target like lower inflation leads to unsuccessful achievement of overall objective stronger economic growth. Yes, if the inflation is less, the economy would be more stronger now because the purchasing power of the currency has become high, strong. You can pay less bucks for more goods. Okay. Now, targets of monetary policy, growth in size of targets. They want to reduce the growth in size of money supply. So targets of monetary policy are likely to relate to the volume of national income and expenditure. So they don't want higher money to be going outside. They want more incoming rather than more money outgoing. They want to decrease. They want to increase the interest rates to control inflation. Volume of credit, they want to give less credit. Okay, and at times, if they want to increase the volume of credit even when the inflation is controlled, when things are normal, they will try to push more and more money outside the bank. Okay, why? Because during the inflationary period, no one showed demand for loans, and the supply was also less. Now after the inflation period is gone, now people will again line up to the bank, and they also want money for their stalled projects. Correct. So they will come and take more money. So that is also a part of in monetary policy. And the volume of expenditure in the economy, like how the people are spending, that also would show about the demand of the products, and how the inflation is there in the economy. And if more and more people spend, that would increase the production, demand in the economy and production, and also the national income increases. Now, money supply as a target of monetary policy, I already explained you. The monetarist economists, the money supply is a possible intermediate target of economic policy. This is because they claim that an increase in money supply will raise prices and more income and money incomes, and this is turn will raise demand for money to spend. So if more and more money is going out from the banks, that means people want to spend more. Correct. So increase in the money supply will raise prices. What will happen? You get easy money, and you know uh, more and more money in the economy, more and more supply of money in the economy. If you're getting easy money, you will try to spend more, and slowly steadily that will increase the prices. Why? Because when you start spending more, you show more demand for certain goods, and when the demand is high, the prices will of course go high. Okay, and same thing, when the prices go high, people demand higher incomes from the company. Even they say we are not able to meet our daily needs because the things are going very costly. Okay, so and this is in turn will raise the demand for money to spend. That's why. So interest rates, I already explained you about the interest rates. Right now, interest rates are very important aspect of the monetary policy. Okay, this would be appropriate if it considered that there is a direct relationship between interest rates and the level of expenditure in the economy. Yes, if the interest rates are high, what will happen? You will deposit more and you will spend less. And interest rates are high, that would make the loans very costlier, and things also become costlier, and you don't want costly goods, correct? So already I have explained you all these points. Interest rate changes brought by government policy affect the borrowing cost of the business. Increases in interest rate will mean that fewer investments show positive returns, deterring companies from borrowing to finance expansion. As I said, increase in interest rate also exert a downward pressure on the share prices, making it more difficult for companies to raise monies from new share issues. Why? Because interest rates are high, and since interest rates are high, the borrowing is very costly. Since the borrowing is very costly, the product becomes costly. The product no one is buying right now, and since the interest rates are high, the share prices would also, the the equity holders will also bear this. And fresh equity, if company wants to like issue and get money, that would also not be easy for them to raise money. Why? Because the market right now is not good. Okay, since the products are costly, inflation is high in the market, people are buying less, so it will be a less profitable company. Now, businesses will also squeeze by decrease in consumer demand that result from increase in interest rates, as I said right now. So now I am giving you an opportunity. Can both of you do a small favor and read this and explain me what is happening here? Or
Yes.
shall I give you the task to do this question based upon the concept? Hello?
Yes, sir. No issue.
Yes, sir.
What say?
Yes, sir. We'll do the homework.
So, no, no, tomorrow I want an explanation from you regarding this question. I have given a very strong explanation of each and everything. Okay, from
Yes.
very
Yes, sir.
from very basics. So I would like you to go into this and understand what is happening here. Every point and every line is important. Okay, let's go
Yes.
for
Yes,
the
sir.
exchange rate. See, what is the exchange rate? Exchange rate is very simple. If you are a person who has international transactions, that means you export your goods to outside countries. So you are an exporter, and there is a guy who imports goods, is an importer. So this business of export and import like requires the payment to be done in different currencies. For example, if someone in United States imports the goods from India, he needs to make the payment of rupee to Indian exporter. So he will go to the United States bank and give dollars. Excuse me. Hello. Yeah. Now, so the person from United States has to like go to his bank and give his dollar and take rupee and pay to India. Okay, Indian exporter. So definitely, uh, if I take vice versa, if we import goods from United States, we need to make the pay, or you want to go to United States for a visit, you need to take your rupee, that is 80 rupees, go to the SBI, State Bank of India, give the 80 rupees to him and take $1. So there is an exchange rate here or not? You are buying one currency by paying your currency or not? Yes. So you can take, yes, there is some message. Just a second. बंद करो. So like if you want to go to United States, you have to pay $80, 80 rupees to SBI and take $1. So you can take this dollar as an apple. Okay.
Okay.
Apple is a fruit, fine. So you can take this dollar as an apple, and like since you want apple, you pay rupee. In the same way, you want dollar, you pay rupee in the same way. Okay, so there is an exchange rate. So instead of buying some fruits or goods, you are buying dollars. That's now exchange rates are determined by supply and demand, of course. See, if lot of business India, if there is lot of manufacturing in India, lot of demand to invest in India, so what will happen? The rupees demand will be up, and lot of payment you have to make to people, to some importer in United States. So dollar demand will be high. So why dollar is a very strong currency? Because dollar's demand is very much high. Any country in the world would accept payments in terms of dollar. If India has to pay for oil, crude oil, and India has to pay some very high amount on daily basis for crude oil, so India has to buy a lot of dollars, because the countries which supply crude oil to India, they only accept dollars. Okay, got my point? So that's the reason why the demand for oil is very high in India, and the demand for dollar is also high in India ultimately, because they won't accept India's currency. India's currency is a weak currency. But India can only create demand for rupee by improving its production sector, more and more foreign direct investment coming to India, FDI coming to India, and they would definitely want to invest in India, so they have to buy Indian rupee to make the payment to the Indian vendors, or Indian companies, or if they want to start a company in India for buying land and all, they want rupee. So the demand for rupee grows up. Okay, that's what. So exchange rates are determined by supply and demand, even under fixed exchange rate system. What is fixed exchange rate system? This is also called as pegged system. So what happens is they kind of fix their currency. For example, 1 rupee is equal to $10. Sorry, $1 is equal to 10 rupees is what I am fixing with United States. Okay, this is called fixed exchange rate system. Whatever the demand and supply forces, they showed high demand or less demand. I don't understand all this. I have just made it clear that $1 is going to be 10 rupees. That's it. So the problem for me is, if United States is a $1 trillion economy, I should always have 10 trillion rupees with me. Got my point?
Yeah.
Both of you please say yes or no.
Yes, sir.
Yes, sir.
Why I should maintain always 10 trillion rupees? Because I should always maintain that amount of dollars, correct?
Yeah.
Yeah.
in terms of rupees. I should be able to pay that. I'm saying an example. We cannot match United States economy. That is a $24 trillion economy. Okay, but with fixed exchange rate, there are pros and cons. Don't worry, you don't have that in your syllabus, so I won't go into that. So governments can intervene to influence the exchange rate by, for example, adjusting interest rates. Of course, they can try to create demand for Indian rupees by increasing the interest rates in India and trying to pull uh, like major investments into India from the United States investors. So with that, rupees demand would be very high, and rupee would be appreciating. Okay, now so they can, excuse me, just a second. Can you give me a second? I'll be back.
Yes.
Yeah. So, yes. So, by increasing interest rates, the demand for rupee is high, and the supply of dollar is high. So, it makes Indian currency to appreciate. Okay. But are you seeing such kind of things right now? No, because of the COVID, our demand is very less. No one wants to invest in India. Barely some companies, one or two. That's not a good sign for our economy. Okay, we are contracting, not expanding. Let's go ahead. Government policies on exchange rates might be fixed or floating exchange rates as to extreme policies, but in between schemes have been more common. So, as I said you, here this is the fixed system, and $1 is equal to 80 right now it is. So, a floating system is we leave this to the market. We leave this to the market. It's a free floating system. Based upon the demand and supply forces, the dollar and rupee value would appreciate and depreciate. When rupees demand is going very high, it starts appreciating and it starts depreciating. When rupees value is down, that means rupees demand is less, it starts depreciating and dollar starts appreciating. The demand for rupee is only will only be high because of some reasons if our dependency on crude oil is decreased. Why? Because we make a lot of payments in form of dollars, so we need to buy a lot of dollars for that. That is the condition. Okay, and the US economy should crumble. Okay, point number two, if we shift our focus more into electric vehicles, we may make our own resources, we show less demand for dollars, buying less dollars. And if we attract more and more FDI in India and try to export more, then that would increase the India's currency value against dollar. You see, China's currency has in 30 years improved a lot, being having so a high population. Even we are still nowhere. So I already explained you this one, and factors influencing the exchange rate for a currency. So what is the fact? What are the factors that influence the exchange rate for a currency? Of course, the rate of inflation compared with the rate of inflation in other countries. See, if the inflation in India is very high, the purchasing power of Indian currency would be less.
Yes.
So India's currency would be going down. Correct? Am I right?
Yes.
So what will happen? India's currency would be very weak. So Indian exports would be good to other countries, whereby the currency is strong in that country. Correct?
Yeah.
Now, interest rates. If the interest rates are high in India, more money comes to India. So Indian rupees demand would be high. So here what will happen if the inflation is high? Supply would be more or demand would be more?
Sir, demand will be
Demand.
more.
Yeah, why? Because like if there is high inflation, our currency's value goes down and we export more. Why? Because our goods are very cheaper in the other markets. So Indian rupees demand increases. Interest rates are high, the demand increases. Okay. Uh, Balance of payments. More and more export, the demand would be high for India. Speculation that Indian economy is going to do well, so Indian rupees demand is high. Government policy on intervention to influence the exchange rate. This I'll explain you with the example. Okay, so we'll stop it till here. Most probably tomorrow's class. Other things are not technical. See, I am only reading point to point till here, till this. Okay, because you don't have an idea about this. Till here, I'm going to read line to line. From here, I'm going to rush. Why? Because these are simple things. Monopolies, restrictive practices, deregulation. We can wind up that in 15 minutes lecture. Okay.
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 So let's take the class day after tomorrow. Tomorrow I may not take the class. Okay.
Yes,
Okay,
sir.
sir.
So day after tomorrow, come with your preparation for that topic, and as well day after tomorrow would be the final class for the chapter number 2 at any cost. If I have to extend, I'll extend.
Okay, sir.
Okay.
Thank you, sir.
Thank you.
Thank you.